I'm Justin Noda.
And I'm Kyle Green.
And you're listening to Mortgages, eh? Let's leave where we've both come from a little bit behind us now and think of where we are right now. So what made you, I know what made me, and I'll get into it after you, but what made you want to do this podcast? Like what was your drive behind wanting to take the time out of your extremely busy day? I know, I've seen your calendar. And put this together, take 2, 3, 4, 6 hours a week, put it together and really be able to put this information out there. Not necessarily what we're talking about today, because today's kind of focusing more about me and you and why we're doing stuff and where we came from. But, in the future, we're going to be talking about all the interesting ways to get deals done, how to underwrite, process, compliance, right? Everything that kind of goes from owning a team to owning a brokerage to being a broker to being an underwriter and kind of putting it into one place. But what was your drive as someone as busy as you are in order to even take this step?
Yeah, good question. I think my fascination with seeing how other people do things and understanding their best practices. And it's very interesting because what you end up finding is that even though a lot of people have great ideas, only 5 or 10% of those ideas are implemented by each of us when you hear about it, or even implementable. And so another broker might have a great strategy for marketing or a great strategy for this or for that. You only have a certain number of days and hours in the week, right? And so you have to look at what marketing strategy or what system works best for me, my team, my approach, the way that I like to do things. But over time, like over my career, I've always been really into interviewing and asking other brokers how they do things. And then looking for a platform to share that information was always very interesting to me. And as from a personal perspective, I'm just very keen on talking to some of the best people in the business and learning more from them about how things work. And the other part of it too is, I kind of missed this part in my story, but I did co-own the brokerage. So I actually became a partner with my initial boss or bosses. And we actually were running that brokerage together. And so I have been a broker owner since I think 2015. But one of the things I noticed in this business is the training sucks. It really does, doesn't it?
It does.
Like how many times have you gone to a new company and it's like, okay, like my training when I first started training people was, okay, come shadow me and write down what I do.
Yep.
And then that's going to be my framework for when I hire the next person. And then the next person, I'm going to like, okay, so here are the notes from the last person. And they look at them and like kind of stare like, okay, that doesn't make any sense. Okay, so I want you to improve it because you're going to do better.
Yeah.
So you're going to watch me do it. And then when there's something that's different, you're going to change it. And then that's going to be the training manual for the next person, right? Like the training is not very good. I think the training needs to be way better in the industry. And so one of the things that I guess I'm trying to do here is try to take this information and just expand it. And I don't want to just do it for our 50 agents inside of Origin. To go down this path, I just feel like as a broker that's been doing it for as long as we have now, Justin, it's important to give back. Podcasts didn't exist when I was a brand new agent. I would have gobbled a podcast like this up.
I bet.
Like, oh man, watching a YouTube video to learn more about how I can do this or that. And hey, I really need to work on a marketing strategy. What are the different marketing strategies? Oh, great. There's like a podcast or a YouTube video or a couple of YouTube videos to show a couple of different examples and different ways and approaches of doing it. Like I wish this information was around when I was a newer agent and building my business. And you got it from talking to different brokers and kind of picking their brain. But some people in Canada don't have that ability. If you're in a small town in Alberta or Saskatchewan or whatever, and you're listening to this podcast and you don't really have that network of people, or it's just too expensive time and money-wise to like fly in to visit other top brokers and get their time, it's difficult. And so I think that just trying to make this information more freely available and just try to get great information and content, mostly on how to get deals done. Underwriting is sales. I'm going to keep saying it. Sorry, everyone. You'll be like, oh God, here comes Kyle saying underwriting is sales again. I get it.
We'll get you a hat.
Yeah, exactly.
Every
right?
time you say it, you have to put on the hat.
Yeah, make underwriting great again. Yeah. Oh no. Let's not go there. Let's not go there.
No.
Yeah. So yeah, that I guess that would be my why,
That's awesome.
and obviously bringing you on board, Justin. I mean, other than your sexy personality and that sexy radio voice of yours, I tell you,
Thank you.
you know, I need somebody that can do all the scripted radio stuff on my podcast. It's like who better than
I
Justin?
bet he can do it. Yeah,
Yeah,
that's my only power. That's my superpower. It's
Your
people
only-
and radio voice.
Yeah.
So thank you for keying in on that. I appreciate it.
You're welcome. You're
But
welcome.
yeah, my role, as you said, and I'm going to keep pushing the fact that we have such a different background, that we have
Yep.
such a different route that we've taken to get here. Mine is more of a like a personal people type reason, in the fact that when I gave up the brokerage and we gave up ownership, I had to move to British Columbia and I had to learn how to underwrite. I had to learn how to underwrite because all my clients are in Alberta. All my new clients are in BC, and BC is so different than Alberta, right? There's credit unions. Now all of a sudden I'm getting more B deals. I'm getting private lenders that I have no idea who they are. So in order to get that, I had to leave home. I had to go, right? I moved back home and worked for a brokerage in Alberta for a little while, right? I was living in Salmon Arm at the time. And I was doing constant trips out to Vancouver to, meet with this prospective broker and underwriting over here for a week so that I'm in-house for a little bit, right? And I was giving up time with my wife and my kid. And so that's what I want to prevent anybody else from having to do, right? I want them to have a place that they can go, whether it's in our community through Facebook, where they can, access us and ask us questions, whether it's listening to this and being able to eventually filter through all the episodes and being like, oh, well, there's one on process and I really want to improve my process, or I really don't know how to read a T1 general. So let's look through here and find it there, right? As you said, improving ourselves inside Origin is wonderful. And I love everybody there, but improving the brokerage as a whole, I think, the industry, the brokering industry as a whole, is kind of the key that I'm taking. So again, it's that that drive that we both have to help people, but it's that personal compared to that numbers brain, right? Where it's, I think it's going to be an excellent value for everybody, and hope everyone can take a little bit away kind of from both of us.
Yeah, 100%.
Yeah.
I think we're gonna have a different approach on the same thing. You're gonna be, not that I'm not humane, but I'm more
No.
I'm more of a business approach
Absolutely.
and more of a systems approach, and
100%.
it's different because that's the way that my brain goes,
Yep.
right? The logic. How do you do this more efficiently over and over and over again? Hey, get me on the phone. I'm a chameleon, like we'll work with the client, but at the same time too, I think that the high level approach of how we do it. Not every broker is going to be aligned with my approach of having a system and a process and all that kind of stuff. Because if you're a one-man show,
Yep.
that's a lot of time to create or invent that. And then for what? It's one thing to improve your own system and approach, but when you're building a team, that's where it becomes a lot more relevant. And we'll obviously talk about that in future podcasts.
Yeah, absolutely. I couldn't agree more. So one of the things that I, again, wanted to touch on is kind of what we're going to be doing in this podcast.
Yep.
So I know that you mentioned a little bit before about your processes, and we keep bringing up your systems and whatnot. But if you wanted to touch on a couple things that you're going to focus in on, key on, as far as future episodes, give everyone a little bit of a tease on what might be coming down the pipe. And then in turn, I'll do the same.
Yeah. So I think one of the things that I really want to focus on when we're looking at future episodes here is going to be underwriting the complex deals. I think that when it comes to underwriting a really easy deal, it's something that most brokers in Canada are able to do and do effectively. I think that where I'd like to double click on would be more on what are all the net worth programs in Canada. What does every bank do, including the lenders outside the broker channel, right?
That's so important, because even when
is.
I was underwriting, half of my underwriting life, I had no clue.
Yeah.
Right. And then I got with some of the bigger guys, and then I had to get a clue.
Yeah.
So if anyone's trying to be an underwriter in the future or have business outside of the broker channel, I think knowing those 3, 4, 5, 6 options is going to be super important.
It's huge. You got to know your competition. And let's be honest here. You don't want your realtors feeling like they have to pre-underwrite a deal and then know if they got to send it to a banker or a mortgage broker. You just want to be positioned as the one-stop shop. I know you got to give 3 names, but I've got 3 people on my team, or whatever it is, So figure out the way of saying, hey, look, I'm your one-stop shop. You're going to send me all of the business, and I'm going to be able to get it done wherever it ends up. If it's best fit with RBC, then I've got a contact or 2 there, and I'm going to connect your client, and it is going to get done. So you call me first, and I'll pre-screen it, and then I'll know if we're doing it or if I'm referring it out. So doing deals outside the broker channel, because of the nature of working with investor clients, the underwriting is so complex. The number of deals that I do outside the broker channel, probably about 15 to 20% of my funded deals inside of Green Mortgage are actually outside the broker channel
Wow.
and fee based. It's a crazy, crazy number. So it's something that we've gotten really good at. So net worth deals, corporate net income deals. So how to read the corporate financial statements and know what you're using there, and then what the different lenders will use and how to follow it. And sometimes it gets really complicated with following the money through different corps. I want to talk about small business lending. I think that that's an important
It is
one.
important.
It's a really, people talk about commercial, they never talk about small business. Well, where does small business fit in that scheme of things,
Right
right?
in between there, right?
Exactly.
Yeah.
Just a little sliver,
It's just
just
a
a little
teeny
sliver.
spot, but it's an important one.
It is, and it's a lot easier to get certain deals done there than it is to try it on the commercial side. And there's some tips and tricks we'll talk about on that. Private lending, and some tips and tricks on how to get your private lending deal assessed and approved, and how to work through that process. I do want to talk at some point about the Smith maneuver, which is basically how to make your mortgage on your residence tax deductible. I think that's a really important key, is understanding how to set that up and structure that properly, and how to coach your client on how to do that. And obviously, we'll be talking about getting some of the top speakers on to talk about their underwriting practices, their systems, their sales approach. I really want to talk about marketing, because a lot of different people have different marketing approaches. Green Mortgage's marketing approach was public speaking and database marketing, and basically rolling that all up into an educational-based marketing program or system. But different people have different approaches. Some people are saying, I have everything that realtors are looking for, and focusing on that. And Green Mortgage never really made it a huge focus to be, the number one landing spot for a realtor to deliver for other clients. That wasn't our positioning. It was more on, hey, we're the best for real estate investors to work with. And so there's all these little nuances with marketing strategies and game plans, and building a team. I think that's really important. Who do you hire first? What is their role? Who do you hire second? And then how do you continue to kind of set up that business? Because I think it's really difficult. A lot of people want to hire help, but they don't know how to do it. What do I pay them? What are the options for paying them? How do I find these people? There's a lot of things that we will go into on that for sure.
Yeah, that's great. And just so everybody knows, I'm going to be representing the underwriters on this side when he's talking about how much to pay the underwriters. So rest assured that I'm going to be keying in on that one. But mostly for me, what I wanted to do is I kind of wanted to take a little bit of a more baseline level with everything involved in the broker world. So I kind of wanted to start at the beginning, because we know lots of the listeners aren't going to be all the other super high producers in the country. There's going to be people who are just starting. Maybe they're 1 year in, maybe they're 2 year in, and they're too embarrassed to ask. Right? That's something that I get all the time is, Justin, I've been in for 5 years and I still don't know how to read a T1 general. Right? How do I read a T1 general? So those type of things are what I really want to key in on. How to read a T1 general, how to track down payment funds, right? Rental offset, rental add back. What was that? The OSFI changes that just came up. I know that's going to be something that we're touching on in future episodes. One thing that I think is super important is how to talk about interest rates, right? How do you talk about interest rates when everybody and their grandmother knows all there is to know about interest rates, right? Everybody says, well, my mom or my dad told me it's a variable. Well, if they told you that within the last 6 months, it's probably the wrong advice. So how do you get that along the lines of not sounding too forced, but still being educated on, for example, where the interest rates came from, right? So we all know you get a fixed rate, you get a variable rate, you 1, 2, 3, 4. That's all well and good, but can you let everybody know how fixed rates and variable rates are formed and where they come from?
I can,
Yeah,
because I'm a nerd.
Perfect.
So, what's interesting too, Justin? There's a lot of brokers that have been brokering for at least a few years, and they don't actually know how rates are determined.
Yeah.
They say, "Oh, the Bank of Canada or the government, et cetera." It's like, kind of, but that's not actually the real answer here. So, I remember my journey, and it actually for me too, it actually took me until year, I think 4 or so, before I actually was able to articulate and understand this better. And it was a guy named Brad Checknita. For those of you that have been around for quite some time, Brad at the time was working with a company called Macquarie Financial, which we did a lot of business with.
Still got trailer fees from Macquarie for a long time after they closed.
Right? So 2012, I think it was, 2013. I was like, I really need to understand this. And he started to point me in a couple of different directions. And from there, I started to really self-learn this. But here, it's important to understand that fixed rates and variable rates are based on different components in the marketplace. The Bank of Canada does not set the fixed rates. They influence it, however. Okay. So if you wanted to get a really easy way of understanding where rates are heading, is you follow the 5-year bond yield. And that 5-year bond yield, Canadian bond yield, is going to tell you where 5-year fixed rate money is heading. So typically what the banks do, and this is going to help kind of understand the framework, banks will lend out money to you and me, and then they'll bundle up those mortgages, and then they'll sell off the bundle of mortgages. And it's called securitization. And basically they're offering offering the real estate as the underlying collateral behind all of this debt. Now, this is actually, you might be thinking, isn't that what caused the subprime crisis?
That's what I was thinking, Kyle.
Really?
No.
Justin, you're a bad liar. You're a terrible liar. So what ends up happening, and what ended up happening, I guess, in the States, was that they were bundling up mortgages and selling them, and they called these CDOs, actually, and collateral debt obligations. Okay, don't need to get too technical with it, but they would be bundling up and selling the debt. And the reason that the subprime crisis actually happened is because international investors were saying, "We love this. This is great. This is all rated AAA." Which we'll get into in a second. This is all rated AAA, and the returns are awesome. We want more of this. And so they kept saying, give us more, give us more. So that would filter all the way down to the bottom ranks in the branches. And then the branch manager would say, we want more deals. We need to fund more deals. We have people that are willing to buy the bag in the back end. So figure out how you can do more deals. And so what ended up happening is they'd call people back and they'd say, hey, I know I told you didn't qualify last month, but we got this new ninja mortgage, available for you.
And what's a ninja mortgage, Kyle?
No income, no job.
Yep. And it was a thing.
Yeah, it was. Crazy, right?
Yeah.
So interestingly, I remember hearing that back in the US before the subprime crisis, if their default ratio was below 4%, so if less than 4% of their borrowers were defaulting, they would be told to push more money out the door. Now, to give you some perspective, during the subprime crisis, the default ratio in Canada was like 0.5. 0.5. So like an eighth of what it was down in the US before the subprime crisis. And the reason that they're pushing it out was because they're bundling up the mortgages and selling them out the back door. Like they weren't the ones holding the bag anyways. And in the US, mortgages, you can literally just hand the keys back and walk away. There's no recourse back in the day, anyways. And so, interestingly, it's that whole mechanism of bundling up mortgages and then selling them is actually how mortgages are funded in Canada. Back in the 80s, it used to be savings and loans, and it would just be primarily the bank would lend out however much money they have in savings. So whatever they have in GICs and in their bank accounts is what they would lend out on the mortgages on the other side.
Is that similar to how a credit union does?
Credit unions also will sell and collateralize mortgages, but not as much. And so they have that as a funding source, but it's a smaller percentage. The big banks, when they have that kind of size and scale, it's a lot easier for them to find buyers of their bundles of mortgages. And in fact, this is one of the reasons why when the whole subprime crisis collapsed, the government in both US and Canada kind of had to step in and say, okay, in order to make sure the money keeps moving, we need to offer more security. And so CMHC actually said, we'll buy more mortgages from you. We'll insure more mortgages for you so that it's easier to sell it. Because now international investors say, well, if it's insured by CMHC, then I'll buy the bundle.
Sure.
Right? And so if you look back at the charts, CMHC's book of how many mortgages they were insuring in Canada had started to spike and skyrocketed. And then somewhere around 2016, they started saying, you know what, we're insuring a lot of mortgages in Canada. We're like in bed with the housing market in Canada. And that means that therefore every individual of Canada is in bed with the housing market in Canada. And so they started to kind of taper that off. And that's actually why in 2016, we saw the stress test come out, but at the same time too, for brokers that were brokering before and are brokering now, that's when all the insured but insurable stuff started to come out. And in the back end, it never was really a thing that affected pricing in the past because it was really easy to take all of these conventional loans, turn around get insurance on the bundle and then just sell it off because CMHC was willing and able to just insure all these bundles, no problem. They call it bulk insurance. And CMHC's portfolio you would expect would be like a high loan to value. Their overall portfolio is like 55% or so loan to value. Because even though they're doing a lot of the high ratio, 95% financing stuff, there's a ton of bulk insurance that happens in the back end. But CMHC said, okay, we need to stop doing that for, amortizations over 25 years. We need to stop doing it for homes over $1 million, which, man, it sucks when you're in Vancouver,
Yeah, that doesn't
Toronto, et
exist
cetera.
anymore.
It's
Yeah.
so crazy that they have not raised that limit since I think it was 2012. They came out with that rule. And so there's a lot of stuff that they haven't done. But now that you understand the framework of how the money comes in and goes out, banks are lending up money, bundling it up, securitizing them, and selling them off. That means that if an international investor can buy a bundle of mortgages or can buy a bond, those are really similar asset classes, which means that if the bond yields are going up, then that means that mortgage rates have to go up to still attract the money. So imagine if you're an issuer of bonds and you have a lineup of people going out your door. You could say, you know what, I have a lot of demand for my bonds. And so, therefore, I can actually lower the yield I'm offering on my bonds. And some people will leave the lineup, but I'll still be able to raise the capital that I'm looking for. So, governments raise money by issuing bonds. That's actually how the printing presses go burr. You heard that meme, right?
Yeah.
That's the government actually just issuing or buying bonds. By issuing bonds or buying bonds, they're moving money in and out of the money supply, and that's how the money supply changes by issuing paper. And literally, if they want to get money into the system, they'll actually literally just buy a bunch of bank bonds and put the money into their bank account, and now money's in the system. And by buying a lot of bonds, if there's high demand for bonds, then it actually pushes the prices up and it pushes the yield down. So the yield is the return that you get on a bond. So high level, that's how the fixed rate system works. So if somebody asks me where are fixed rates heading, I pull up my 5-year bond chart, and we'll put it in the show notes as well for the 5-year bond chart that I typically use.
The actual link to the... Okay,
Yeah.
awesome.
I just go to investing.com. There's a Canadian 5-year bond yield. It's the easiest way of getting a proxy for where interest rates are heading.
Okay.
And if you wanted to understand where the shorter term fixed rates, we've observed this recently where short-term fixed rates have had a lot more movement than the longer term rates have, et cetera. But you can also check the shorter term rates to get an idea of where short-term money is heading. Because if they're issuing a 1-year fixed rate mortgage, then that rate has to be comparable to a 1-year bond, right? So then the only other thing that you need to know is when they determine the pricing is what is the amount that they add to the bond rate to accommodate for their risk, for their profit, for
Sure.
servicing and all that stuff. So in general, if you add about 1.4 to 1.8% on top of the 5-year bond yield, that's approximately where a 5-year fixed rate mortgage is being priced. And usually in the lower end, 1.4, it's probably an insured mortgage. 1.8, it's probably an uninsurable mortgage. And the reason that you see the difference in pricing there for insured or insurable versus conventional, it's a lot easier for a bank to sell off a mortgage with an insured and backed by the Canadian government. And guess what? If it's an insured mortgage, the borrower pays the insurance premium. And so that makes it a lot more of a effective tool for the banks to use to sell it. If it's insurable, then it's still easier to sell it off, and you don't need to put as high of a price on it. But at the end of the day, the bank is paying for the insurance premium or the lender. And that's why the rates are a little bit higher than insured, unless it's at 65% loan to value or less, in which case the insurance premiums are very cheap for the bank to get insurance. And then you have conventional, which is very hard to sell off. And in the back end, when you deal with all the non-bank lenders, usually what ends up happening is the major banks are buying conventional mortgages off of the non-bank lenders. And so they're usually getting their money from some of the big banks in Canada. So First National, I don't know if they want me saying this online because they usually want to keep their investors close to the chest, but I think it's fairly common knowledge that a lot of their money comes from TD and Scotia. MCAP, a lot of their money comes from BMO. CMLS, I believe, gets a lot of money from RBC, et cetera. So all of these banks will buy bundles of mortgages from the non-bank lenders. And that's actually why you'll see that the non-bank lenders tend to change their guidelines and policies a bit more frequently because their investors might be changing. And also their investors, i.e. the banks buying these bundles of mortgages from them, might say, you know what, we only want this much of this type of product or this type of mortgage right now. And so they kind of change it and move it around. So that's a really long history. We only talked about fixed rates so far.
That was so. I'm gonna pipe in for a second just to keep on my new agents that are going to be listening.
Yeah.
I need a 1-word answer from you. When bonds go up, fixed rates go.
When bond yields go up,
correct.
Fixed rates go up,
and vice versa.
Yep, vice versa. At about 1.4 to 1.8% on top of it, that's generally where the rates are heading.
Perfect.
So if you watch the bond chart, and I usually pull it up every day or every 2 days, if I notice that there's a bit of a spike in the bond market, get ready to send in your rate holds. Start calling your clients and telling them, hey, I think rates going to go up pretty soon. You need to get your application into me ASAP so I can get your deal out the door.
And I remember this because when I first started, I didn't understand any of this either. But they always ask about it. How come the rate's going up? Why is everyone else going up right now? What's going on? And I always had a canned speech that got me out of having to explain.
Well, what was it? What was it?
It was, if you're ever wondering why rates are doing what they're doing, it's connected to the bond rate. And if you're looking for something to help you sleep tonight, I'll send it to you. Guess how many people have ever asked me for anything?
Yeah, I know.
None.
Yeah.
So it got me out of the conversation, but it also didn't get me more informed. But as you said earlier in the podcast, we never had podcasts when I started. So again, being able to reach out and bring in this kind of full circle and having a place where people can find this kind of information, I think is going to be super valuable. Did you want to touch on variables?
I do, yeah, for sure. And I do want to really quickly talk about just an extra little thing to add to the fixed rate conversation.
Of course.
Number one, with what you're talking about, you have to understand your consumer and the customer that you're talking to. When I talk to, I dove into this deep because I'm interested in it personally, but also my investor clients want to be educated. That's important for them.
Absolutely.
A homeowner is just like, get me through this mortgage process so I can own my home, please.
I want to know my rate. I want to know my payment.
Right.
And I want you to not ask me for any more documents.
Exactly.
And
right.
that's about it.
And then investor clients are like, educate me. Give it to me.
Absolutely.
Slather me up in that bond yield talk. Give it to me, baby. One more time. So I think that's where it depends on the client you're talking to. Engineer types. I know a lot of brokers like, oh, engineers. I hate talking to engineers. And for me, it's like, I love engineer types.
Yeah.
They just want to know why. And I can explain the why all day long. And as soon as you do that, they're hooked because you're the only one that's ever told them why.
Everyone else says they're going to send them an email.
Yeah.
Saying,
I probably stole a lot of your engineer clients from you, Justin.
Did.
Yep. And your first time home buyers are like, Kyle Green just doesn't hold my hand enough.
Exactly.
Yeah.
And I will hold that hand all day long.
Yeah, exactly. So the only other thing I want to mention on the fixed rates is we talked about how there's a 1.5 to 1.8% premium above bonds. That can change too. So in COVID, for instance, the premium above bonds was more like 1.2. And that's because there's so much money in the system and so much, and there was very little risk perceived in the marketplace. So the overall money supply and flexibility and freedom of credit also impacts the premium over top of bonds. And so that's an important thing to keep in mind too, is that it really depends on the market circumstances. And that's where it's harder to know unless you're really kind of following, you're not going to be able to see this on a chart anywhere saying, hey, this is what we're doing. Unless you can kind of get a general sense, and I might be following some things like the volatility index and a few other things like that that give you an idea of what the spreads and the future spreads might be coming up to. And if you look at it, then the spreads over top of these bonds in recession times starts to increase because the flow of credit starts to tighten.
Sure.
So let's talk about variable rates now, because this is also a component of that. Variable rates are, of course, priced by the Bank of Canada, which sets the overnight lending rate, and then the lenders set their prime rate. And the prime rate with pretty much every lender except TD is 2.2% over the overnight lending rate. So right now we're at 5% overnight lending rate, and then 2.2 above that is 7.2. So Justin, do you know what the overnight lending rate is? Like, what is that?
Yeah.
Exactly. So the
you caught me off guard on that.
I got
one.
you. I got you.
Get me. I wasn't ready for that one.
No, you weren't. The overnight lending rate.
Actually, can I send you an email?
No.
It'll be great for if you're trying to get to sleep later. I can send it out to you if you want it. No,
it's okay. I'm an engineer type. I want to know why, exactly. Justin. I want to know why. So the overnight lending rate the easiest way to understand it is that banks lend money back and forth over all the time. And let's say that RBC cashed way more checks that day than BMO did, but they kind of owe each other money at the end of every day. So the overnight lending rate is the rate at which banks will lend money to each other, or the government will step in to just lend money overnight to balance the books. Because every day, hey, this many checks were cashed. And usually the banks just do it internally between each other. But the overnight lending rate is set as a mechanism to ensure that the books are balanced at the end of the day. And it's money that comes from the government to just balance books every day.
Interesting.
That's what it actually is. Yeah. You know what? I did learn something in college, Justin.
You did, and now see, I didn't even go to college, and now I learned what you learned.
Exactly.
So it's that different paths that all come together.
Perfect. So the prime rate, obviously, I mean, I think the prime rate is the one thing that people focus on, and probably the thing I don't need to talk a lot about. But if a customer is asking me, or if I'm explaining to them how rates are calculated, the quick snapshot is the Bank of Canada meets every approximately 6 weeks to determine if they're going to move the prime rate up or down. I don't even talk about overnight lending rate. I'm not going to discuss that with most clients. I'm just going to say to set the prime rate, because there's no point in spending an extra 15 seconds and confusing people, which is, again, going back to communicating complex things to customers in an easy way. If the engineer's like, wait a second, isn't there an overnight? Yes, okay, you're a very smart, intelligent person. Let's talk about it. But for the most part, 95 out of 100 people, you just talk about the government sets the prime rate. And then they're setting that, and it's based off of macroeconomic factors like the dollar, like the imports and exports, the growth rate, the inflation rate. And obviously right now we know it's all about the inflation. That's why interest rates have risen so much. But it's all of these factors that government's trying to dial, move those dials and keep the economy in a nice, safe, comfortable target zone, right? And so that's what they're doing. And on top of that, you don't just have the prime rate, because you're getting, if it's a mortgage, usually it's prime minus, and if it's a line of credit, it's prime or prime plus, right? So you also have the premium or discount attached to the prime rate, and this is the one that it's actually very difficult. Even some of the smartest people don't have a easy way of describing, explaining how this is calculated, but it's effectively triangulated via a number of different things, and so they're looking at. And one of the easiest ways to look at it is it's the difference between government issued debt and privately issued debt, or commercial debt is what we call it. Okay. So if I'm a bank or a company issuing debt, what is my cost compared to what the government issued debt's cost is? So as an example, in COVID, money was moving around so much, right? And so I do say that in a way, it's kind of tied to the money supply and increases to the money supply, because generally the more money there is, the smaller the gap between commercial debt and government debt is. And that smaller gap represents a deeper discount on a variable in general. When we see things tighten up, as an example, like in the subprime crisis, for those that are around back then, we actually went to prime plus 0.8 was kind of the standard interest rate across the board.
I remember.
When we had COVID happen, we went from prime minus like 0.6% to like prime, and then prime plus 0.2, like almost overnight. It was crazy. And so these movements are, going back to us, I touched on a little bit on the fixed rate side. It's the spread, and the spread is based off of the volatility index, is based off of the freedom of money flowing around, the difference between commercial paper and government paper. But even if you ask really smart people, it's really hard to like nail that down and say how exactly are variable rates calculated. And so that's not an easy thing to just pull up one chart and say, oh, here you go, here it is. Much more difficult to understand where the discounts off prime are heading. I think it's easier. Well, okay, the last 2 years maybe hasn't been easy to predict the prime rate, but in general, easier to predict the prime rate than it is to predict the changes in the discounts off of prime.
Yeah.
Yeah.
Yeah, no, that makes sense. Super interesting too.
Yeah. Yeah.
So on the podcast, we wanted to put in another episode that we haven't talked about yet. That's called Back in the Day is what we wanted to do it on. And what we wanted to do is kind of reflect a little bit on what has happened in the past, and not necessarily in like pre-COVID, but we're talking like, pre-2008, pre-2001 even. So today, I just wanted to pick up on the interest rate talk that we were doing as well. So before all this kind of stuff happened, and rates were so determined by insured and insurable and conventional, right? Where rates really are different depending on, and now they're actually different depending on the client and the credit and the loan to value. Back in the day, they were not.
No.
How did you cross that bridge when a client said, "Hey, what interest rate am I able to get?" Because I know now it's like, well, I have to get you. I need an application. I need your credit history. I need to, give me your letter of employment and your pay slip. Then I can pull your bureau. And are you going to go to a big bank? Are you going to go to someone who does insurable or insured? Right? There's
Yep.
so many questions and so many variables that come along with that. What rate can you get me question? That I just kind of wanted to have you touch on from your expertise, at least back before all that kind of craziness started to happen. How did you have rate talks?
Yeah, well, I guess there's two parts to that equation, because if somebody called you and asked you what the best rate was, I could actually tell you what the best rate was that day.
Right off the bat, right? It was
Check
so
first
easy.
line's rate sheet. Here's the best rate.
Yeah.
Done, And it was just one rate. It didn't matter whether it was insured or insurable, or whether it was a rental property, or was this program or that program, or anything like that. And again, the reason it was like that, Justin, because the flow of money didn't matter. So we actually didn't talk about this, but like when those mortgages were bundled up before the subprime crisis, those CDOs, they called them, were sprinkling in a bunch of AAA mortgages with junk mortgages in between. So it didn't matter whether it was a junk mortgage being priced and placed, or whether it's a AAA, they got the same pricing because they were getting put into the same bundle where the pricing was the same, right? Nowadays, however, banks have all of these different things. The governments are saying, hey, we need to make sure that only a certain number of your mortgages can be non-conforming on your books. You'll find that credit unions in particular, they come in and out on investor financing, so rental properties. They say, oh, we've hit our targets. Now we're backing off. We changed policies. We changed the rates. And oh, now we have money again. Okay, we're back in it again. The banks do this to a certain extent, but they have much bigger books. And so it's easier for them to move it around a lot. But the key was, it was a lot easier to just say, here's the rate, Now, that being said, from a sales perspective, you don't necessarily want to just tell them what the best rate is, right? So there's a lot more that goes into that. And I think that that's something that is a much longer conversation, but from a high level perspective, and this would be something we should talk about. We should talk about how do you deal with when somebody asks you what the best rate was. We're going to save that for another podcast. Too bad. But really high level, I think that it's important to think about, do you want to just tell the customer what the best rate is before you get some kind of obligation or some kind of commitment to you, right? So, I would even say, even if I could quote the best rate or what the rate was back then, I would still ask some qualifying questions.
Sure.
Because I want to understand, well, it depends on what you're doing, even though it really didn't. But what are you doing? Okay, great. Have you talked to your bank yet? Or who else have you spoken to about the financing? I really actually like that term even today. Who else have you spoken to? Not have you spoken to your bank yet, because maybe they spoke to another mortgage broker, or maybe they spoke to a different bank, not their bank, but a different bank. You're kind of opening up the door for them to do that. Or if you ask, who else have you spoken to? It's almost like, I know you've spoken to somebody else. Who was it? Yeah. Who was it?
It's true. It puts you on a better foot.
And then I get a way better response, because then they're more honest and they say, well, I talked to this person. Okay, great. So what do they offer you? Because I don't want to waste your time or my time collecting a bunch of documents and doing all that work only to find out that the rate you've been quoted, I would have just sent you right back to that bank anyways. And you're always trying to position yourself in the driver's seat. I would have sent you back to that bank anyways, makes it seem like you would have done the right thing for them and sent them back there, as opposed to, oh, you would have had me beat. Yeah. It's a very different way of approaching that. And so I think the words that we use is really important, Yeah.
No, I agree for sure. It's like the talks when transfers come up, right? And they automatically say, what are your rates and what are you going to give me? And you always want to make sure that they get a quote from their bank, their existing mortgage lender first, right? To put you on the better foot. So now that you're not the one who's being reactive, you're being proactive in regards to getting that rate first, and then being able to come back with hopefully a better rate or a similar rate. But as far as like rate adjustments and what goes, I just wanted to touch back on before we wrap this up, I just wanted to touch on the back in the day thing, because back in the day, we actually had more power to get a rate modified. Yep. I found, right? Without having to buy down with our commissions, without having to, do anything else to get that 349 to 345 to be able to compete with them, we could actually call. And it was those relationships that either the broker owner or that broker had with the existing lender that said, hey, Bill, remember we went out for beers the other night, right? Yeah, and yeah. I have this and this. And you know, 9 out of 10 times when Diana, who was my mother-in-law and my broker owner when I started, she made that phone call. right? And instead of beers, it was probably hang out and have some cigarettes, right? That's just what happened back then.
Yeah.
And it was that relationship that got formed that allowed them to get that rate down without any buy down, without any this, because there was that little bit of buffer that they must have built into the rates at that point. That I don't know about you guys, but I don't see that as much anymore. Now it's if you want it bought down, then you have to buy it down.
Pretty much, yeah. There's certain points, and I will say, when you do a certain amount of business, there is a certain element of that.
Sure.
Some of the banks will look at it, and we've been able to get that done with Scotia on certain deals. Not lately a whole lot, but certain deals sometimes, and certain lenders are a little bit more inclined to do that, but a lot of others are not. And usually the best way to position that is, hey, it's not before you send in the deal. It's actually after you've sent in the deal and you're basically file complete. And then you're like, hey, I'm going to lose this deal. Can you work with me here on that? And usually it helps if it's kind of a meet in the middle thing.
Yeah.
I'm going to buy down part of it. You guys come down the other part and let's meet in the middle. It usually isn't going to work if in today's world where you say, hey, lender, I need you to come down 10 bips and I want to get full commission still. So not going to work. Not in
you're
today's
gonna
world.
met with a little bit of a brick wall on that one most of the time.
Exactly.
But no, that's super interesting. But that's kind of all the information that I wanted to cover today, and that I know you wanted to run through as well. This was fantastic. I had fun today.
Yeah, awesome. Well, looking forward to the next episode, and we look forward to educating everybody on current events, what's timely, what's fashionable, but also we will be doing some deep dives on some of these important topics on how to build a brokering business. I think that's really important. Looking forward to the next episode.
Awesome. Me too.
Yep.
Have a great night, everybody.
Yep. Bye now.